Most people think that property investors make money from rent. That's not true. This flat I own rents for £2,500 a month, but the actual cash flow is only around £550 before any repairs. So where does the real money come from? In this video, I'm going to show you exactly how property investors actually make money using 3 examples from my portfolio. How I pulled £187,000 from a single property, how a £30,000 investment turned into £100,000 worth of equity, and how I released £244,000 tax-free from one property to buy another. And once you see this, you'll realize why focusing on rent is one of the biggest mistakes beginners make. The biggest property myth. Most beginners think property investing works like this. You buy a property, collect the rent, get rich. That's the biggest mistake you can make, because if you only focus on rent, you'll grow very slowly. That's how landlords think, not how investors think. Serious investors think very differently. They think like capital allocators, which simply means, where can I buy something below its true value? How can I increase that value? And how quickly can I get my money back to do it all again? Once you start thinking like this, property investing becomes a completely different game. And most people never realize this. And to understand it properly, you need to understand something called the property profit stack. The property profit stack. Most people only think about one layer, rent. But experienced investors understand there are multiple layers of profit. The real money comes from stacking these together. This is what I call the property profit stack. Buy below market value, reconfigure to add value, refurbish to add even more value, refinance to pull your money back out, and repeat. Long-term appreciation. Notice something important. Rent doesn't even appear on this stack. And that's because rent is usually the smallest part of the return, which I'll explain later in this video. Now let me show you exactly how this works with real deals, including one where I pulled nearly £200,000 out without selling, where the big money actually comes from. Now comes the powerful part. I want to show you 3 real examples. Example 1, my London Bridge flat. I bought this flat for £250,000. Over time it increased in value to £500,000. Now here's where it gets interesting. At £500,000 I refinanced the property at 75% loan to value, which gave me £375,000. I used that to pay off my original mortgage, which was £187,500. This means I pulled out £187,500 in cash, but I still own the property. I still have £125,000 worth of equity, £550 per month cash flow. So from just one property, I now have monthly income, equity, and nearly £190,000 released. And here's the key point. I didn't sell that property. That money came from refinancing, which means it's not taxed like income or profit. This is where most people get property completely wrong, because most people are focused on the £500 a month, when the real gain was nearly £190,000. And it doesn't stop there. Let me show you something else. This is the current layout, a 2-bedroom flat. But originally the kitchen was at the front of the property. So my plan is to move the kitchen back and turn this into a 3-bedroom apartment. That does 2 things. It increases the value of the property and it increases the rental income. So even after refinancing, there's still more value to unlock. And you can probably guess what I did with the money I pulled out. I used it to buy more property. Example 2, my previous house. Let me show you another example which might surprise you, because on paper it doesn't actually look like a great deal. I originally bought this house to live in for £445,000. After about 7 years it was valued at £750,000. I refinanced it at 80% loan to value, which gave me £600,000, and I used that money to pay off the original mortgage, leaving me with £244,000 released. And again, I still own that property. Now if you looked at just the rent, it's about £2,200 a month, and the cash flow is roughly £500 to £600 a month. So on paper, it doesn't look that impressive, but that's exactly my point, because the rent is just the surface. The real money is underneath. The real money came from releasing £244,000, and I used that money to buy more property. I actually really like this house, which is why I've held on to it. Because my plan is to do a double-story rear extension and turn it from a 3-bed into a 5-bedroom house. That moves it into a completely different price category. That's what I call a category jump. And that's the key idea. You're not just holding property, you're constantly looking for ways to increase its value. And again, I use that capital to move into my next project. The next one shows you how thinking bigger can completely change the outcome. Spring Road. I bought this property for £805,000 with a plan to convert it into 2 houses. Each one would have been worth around £750,000, giving a total value of about 1.5 million. Now this is where thinking like an investor becomes important, because once you create that value, you have options. And that's where real investors make their decisions. I could have refinanced both and held them for the long term, or sold and realized the profit. But in this case, I actually decided to refurbish the house and move in. I've got some interesting plans on this one. So this is the end of the garden here, and these are double gates, and just behind the double gates is a road, and this road that goes up and round is there's lots of bungalows there, which I'll share in another video. This is why I say don't think like a landlord, think like a capital allocator, the refinance strategy. Let me give you another example. This one is really important. I bought this flat in London Bridge for £330,000. I then spent about £27,000 refurbishing it, turning it from a 1-bed into a 2-bedroom apartment. After the refurbishment, the property was worth £450,000. Now look what happens next. At £450,000, I refinanced the property at 75% loan to value, which gave me around £337,000. That paid off my bridging loan and most of my other costs, but I still had about £30,000 left in the deal. So what did I end up with? This is where property gets really powerful. A property worth £450,000 with £112,500 worth of equity and only £30,000 left in. And on top of that, it produces around £800 a month before maintenance. That's roughly £10,000 a year on £30,000 left in. That's a return of 30% per year, and I don't have to wait 10, 20 years for that to come. That came from creating value, not just collecting the rent. This is what's called forced appreciation, where rent actually fits in. Now, rent still matters, but not in the way most beginners think. Rent does 3 things. It pays the mortgage, it covers the costs, and it gives you a bit of extra income. But its real job is this. Rent allows you to hold the asset long enough for the real profits to work. Think of rent like the fuel in the engine. The engine itself is value creation, equity growth, capital recycling. That's where the real money's made. Rent just keeps you in the game. The metrics serious investors look at. This is where most people get property completely wrong. They focus on monthly cash flow, but experienced investors focus on something very different. Return on the money left in the deal. Let me show you what I mean. Imagine after refinancing you only have £10,000 left in a property, and that property produces £3,000 per year. Most people will look at that and think, oh, that's a 6% return, but that's wrong. Because you don't have £50,000 in the deal anymore, you only have £10,000 left in, which means your actual return is 30% per year. And once you understand this, everything changes. Because now you're not just buying property, you're optimizing your capital. The economic concept, capital velocity. Economists describe this idea as capital velocity. The faster your money moves, the faster your wealth compounds. Now let me show you what that looks like in practice. The slow way to invest in property is this. Buy one property and wait 20 to 25 years. The faster way is very different. Buy, reconfigure, refurbish, rent and refinance, and then repeat. Because every time you go through that cycle, you increase your asset base, and over time, that's what really builds wealth. Not time alone, but how fast you can recycle your capital. Why most investors struggle? The reason most property investors struggle is actually very simple. They focus on the wrong thing. They ask, how much rent will this property make? But that's the wrong question. The better questions are, Am I buying below market value? Can I add value? Can I refinance? And how much money will I have left in the deal? Because once you understand this, property investing stops being about rent and starts being about capital growth and capital efficiency. And once you start thinking this way, you stop acting like a landlord and start investing like a professional. If you want to become a serious property investor, you need to stop thinking like a landlord and start thinking like an investor allocating capital. Because once you understand the property profit stack, you realize something important. Rent isn't the main profit, it's just the thing that keeps the machine running. And the real money comes from how you buy, how you add value, and how you recycle your capital. That's how you actually build wealth through property.